Jivika, can we start the meeting?
Yes, sir.
Morning, everyone. Myself, Venkat Kalva, President for Bangalore Value Association. I welcome all members for this today's webinar on purchase price allocation. First of all, I thank Mr. Bhavik for taking this session, purchase price allocation. Before the session starts, okay, just I would like to give small a brief on IBBI notices which we are receiving as a valuer. I request all members to take proper care while issuing reports in IBC process. In the recent past, IBBI issuing notices to the valuers also. We have seen there are suspension cases in plant and machinery and SFA, especially in IBC cases where the valuation is not doing properly, or where the valuation they have mentioned in the report, like just they are giving the methods like income method, net asset value method, market value method, but proper reason is not giving while calculating the value amounts, especially in like inventory and trade receivables. In IBC cases, we have a dilemma, like who has to do the valuation of inventory, whether it is a plant and machinery or registered valuer. That we need to take at the time of assignment, at the time of accepting the assignment, we need to get the information from the resolution professional who is going to do the valuation. And also in the trade receivables, usually as valuer, we will give the zero value, treating that we don't receive any amount. But the IBBI is thinking that why not 20-30% amount is going to be received from the valuer? Why you were not treated like that? It is all debatable question, but please take proper care in giving the reports, and also please mention the justification and the representation letter which you are receiving from the resolution professional as well as from the management. And dealing IBC cases is very difficult because even the resolution professionals will not be having proper information for distributing to us. With this, I request Jivika to introduce the today's speaker to start the session.
Yeah, good morning, everyone. It's my pleasure to introduce the speaker for the day. Mr. Bhavik Shah is a chartered accountant having experience of more than 13 years. He's a director of Transaction Square, Mumbai, and is a part of the financial advisory services practice. He has also been a speaker at various forums of ICAI, ICSI, and ICWAI. He has authored various articles which are published in the Journal of Chamber of Tax Consultants. He is the managing council member of the Chamber of Tax Consultants for the financial year 22-23. We welcome you, Mr. Bhavik Shah. We are delighted to have you here today with us, and we look forward to your session.
Thank you, Jivika. Thank you, Jivika. So I'll just share the presentation. Am I audible?
Yes, sir.
You are audible.
So is the presentation visible?
Yes, it is visible.
Okay. So thank you, Jivika, for a kind introduction, and thank you for inviting me, the Association of Certified Valuators and Analysts. It's great. In fact, this is the first time I'm presenting something so early in the morning, and it is good to see so many people who have joined this session. So it shows that people are eager to learn, and it's a fairly complex topic, and I'll try and do as far as possible a justice to it. In terms of the Q&A, I'm not sure as to how do you go about it, but whatever questions you have, you can unmute and you can ask at that point in time. I'm okay with that. You can stop me at any time. With this, let's start with the presentation. So what is the objective of this exercise is that I would like to cover the basic principles of Ind AS 103. So we'll brush through this basic principles, assuming that all of them will be aware, but this is just to set the tone right for the for explaining what PPA is all about. The next will be who can undertake the PPA engagements. What are the steps to be undertaken for valuing the or undertaking the PPA exercise and specifically valuing the intangible assets? What are the principles of WACC, WARA and IRR analysis? And Mr. Venkata just mentioned in the morning that there has been a scrutiny which is happening in the IBC cases. More often than not, this will also fall down in terms of the peer review for all the registered valuer reports which are going to be issued by us. So how do you take care of that, and how the principles of WACC, WARA and IRR analysis will help in undertaking the PPA engagements? We'll also look at the practical case study as to how you perform a PPA exercise, and I have tried and covered most of the income approach methods, which is one is the MPIM and the with and without and the RFR method, so that everybody can get a view as to how you calculate a valuation using these three methods, and how the WACC, WARA and IRR analysis will look like overall. And lastly, we will cover in terms of the report writing, what are the nuances that one should not miss in terms of writing of a report for undertaking a purchase price allocation. The duration that I plan to cover will be around 2 hours, including Q&A. And that shall be the endeavor for the first 90 to 110 minutes. And the last 10 minutes, we'll leave it open to the floor for Q&A. So coming to this, what is a PPA? Basically, PPA has not been defined anywhere in the Ind AS, but it is a practice to allocate the purchase consideration to acquire an asset or a business into a tangible and an intangible asset. And everybody knows what an tangible asset is. Basically, it is inventories, as sir was mentioning, a PPE or a working capital, etc. But what is an intangible asset? And intangible assets are those assets which provides additional economic benefits when they are put to use with the other tangible assets, or they provide economic benefits independently also. So, as I said, it is a that it is a practice to allocate the assets or the business to various tangible and the intangible assets, and whatever is the residual purchase consideration which remains is allocated to a goodwill or a bargain purchase in terms of the accounting in the books of the acquirer. And PPA is becoming more and more common nowadays, though it was there earlier also as part of the old IGAP in terms of the AS14 when there was a merger or a demerger happening, or a slump sale which was happening in terms of AS26. But now it is more common as the companies are moving to adoption of Ind AS, and PPA is required as part of Ind AS 103, which is a business combination. The Ind AS 103 specifically states that the purchase price allocation or a business combination standard will not apply to formation of a joint arrangements or an acquisition of an asset, and which is not an acquisition of a business per se. So technically, if you are acquiring just an asset, then a business combination standard or a PPA will not be required. So as I mentioned earlier, a PPA is a fairly complex process. It requires deep understanding of the business and deep domain knowledge in order to do this exercise. And we will try and cover as to how do we do justice to this kind of an assignment. Sorry. I'm not able to see my screen properly. There has been a cut. Anybody can guide me? What should I do?
Clear your screen.
Your screen is visible, sir.
No, it is not visible to me. In terms of the header, it is getting stopped. There is some menu function which is coming.
Unshare and share it. Go to PPT mode. You can see it. No, but for him,
Okay.
I think.
Yes, your header is also seen.
Okay. So coming to what constitutes a business combination. Now, business combination, it is, so business combination has to be accounted using an Ind AS 103. So it is important to understand what constitutes a business combination. And business combination is defined in Ind AS 103 as, is defined where an event where an acquirer obtains control of a business structure based on some legal or a tax consideration. So some of the examples which comes to my mind is basically, if it's an acquisition of a majority stake in an entity and it's an equity stake purchase consideration, then that will qualify as a business combination. If it's an acquisition of a business through a slump sale, that will qualify as a business combination. If it's a legal merger, a merger of A getting merged with B, that will again qualify because the acquirer is obtaining the control. If it's a merger, but A being a larger entity and which is being taken over by B, then it is a case of a reverse merger and the accounting implications will change in case of a reverse merger because it has to be accounted in the books of D, but there is some complications in terms of the Ind AS, but we are not covering this. But again, this is defined as a situation in an Ind AS when there is a reverse merger where a larger entity is being absorbed by a smaller entity. And if there is a combination and A and B is getting merged and C is being formed and the control is getting changed, then then in that case is also Ind AS 103 will be applicable. Now, what do we mean by control? Control is basically, it's a power to govern the financial and the operating policies to obtain benefits from its activities. So if with 40% also there is a control which is there, then technically that standard gets triggered and the purchase price allocation has to be undertaken when there is an acquisition of 40% or a 45% stake also.
Bhavik, I just have one question. Can I please interrupt?
Yeah, please.
So the fundamental question that I have is, we are talking about Ind AS 103, right? So is it only applicable to large size, large format organization, or should it also be applicable to smaller where the turnover is less than 50 crores?
So there is a turnover criteria, but beyond 24, everybody has to move towards Ind AS. Now, this is a guidance which is given in the Ind AS, but guidances will remain the same also as part of the IGAP. So just to give you an example, we were doing one case in terms of valuing a reacquired right. Though IGAP was applicable to that entity, but we draw a guidance from IFRS or Ind AS per se to value those assets and account that in the books of the acquirer. So technically, when I'm discussing that this is basically applicable to Ind AS, the Ind AS is more principle based basically, and there are more examples which are covered. So the guidance is drawn from that, whether you are following Ind AS or in IGAP accounting. And over the time, everybody will have to converge to Ind AS only. So today, as you mentioned, for a smaller entity, they have an option to continue with IGAP, but over the time, it has to converge to Ind AS. Does that answer your question?
Yes, Bhavik. And also assuming that it will also take into consideration a slump sale of a business. Like for example, if there is a slump sale, your PPT you mentioned acquisition of business by the acquirer will also include a slump sale or an asset sale.
Asset sale will not be covered. Asset sale, even IGAP never covered it. The old Ind AS never covered it. Asset sale will be not accounted using an Ind AS 103. It will be, so there is no fair valuation required over there in terms of an asset sale. But if it's a business sale through a slump sale arrangement, then technically, yes, a PPA is required, whether it is IGAP or whether it is new Ind AS.
Thank you, Bhavik.
Thank you.
So, Bhavik, you are saying, is there a sunset clause for moving to Ind AS? But tools because net worth is that continues, no?
The net worth of 100 crores or something is there right now that continues. I'm not sure about the sunset clause. But more from a valuation perspective, I believe whether it is an Ind AS or an IGAP, it does not matter for the valuer because the fair valuation accounting is required. So moving on.
Just one more question, sir. I think it is
Yeah.
important and relevant also. So, the valuation report, should it necessarily be signed by a registered valuer, or it can be
Sir,
signed?
ma'am, I'm going to cover that. I'm going to cover that as part of the presentation. Yeah.
Okay, sir. Thank you.
Yeah. So, what constitutes basically a business? Is it possible for everyone to mute? I'm getting some disturbance over here. Okay, thank you. So what constitutes a business? So business under Ind AS, it is defined as it has to consist of three things. One is the input, the processes, and when the inputs and the processes are applied together, has an ability to create an output. Now, what do we mean by an input? So input is something which when it is applied with the processes, with the set processes, will create an output. So let's understand in terms of an example, what am I trying to say over here? So there is a shipping and a warehousing company which provides shipping and storage services. And there is a consumer retail company which plans to purchase the several warehouses from X, which is the which provides shipping and warehousing services, to use these warehouses to enhance its distribution services. Now, Y has acquired the land and warehouses from the X, but does not take over the warehousing contracts with the third parties. So right now, what is the role of X? X is providing shipping and storage services to a third party. Y is planning to buy the warehouses from X, but they are not ready to take over the contracts which are there. So technically, they are purchasing the assets only and not the business. Now, what is the business of X? They have warehouse, they provide certain services in terms of the storages in those warehouses, and it creates an output. So technically, this is how you have to put it, that there is an input and there are processes which are there, which will ultimately give you a shipping and the storage services for X. So technically, the business is not being transferred, and this is only an asset transfer. Is this very clear?
So, but does it also mean that the employees who are working in that warehouse continue to, once the business acquisition happens, that they will become the employees of Y company?
No. So in
I
this
understand
example,
that the contract is not transferred, but what about the employees?
No. So that is what I had mentioned, that Y has acquired only the land and the warehouses from X. So technically, there is no transfer of the contract of the employees which is happening. And hence it is an asset purchase and not a business purchase. In terms of a business purchase, yes, the land, the contracts, the employees, everything will get transferred. So let's take another example, ma'am, that when, let's say, you have a factory which is built, but which is not commercially operationalized, but you have employees, you have factories, you have everything in place, and you are waiting for certain regulatory approvals to come in, and then you will start the production. So in that sense, in that case, whether that will qualify as a business or not, in case you are transferring that. Sorry, who was asking me? This is a question to you, ma'am.
Sorry, sir, I just got distracted. Could you please repeat that?
So I'm saying, let's take one more example in terms of, let's say we have a factory which has not commenced production, but the factory is built, ready to use. We are waiting for certain regulatory approvals. And once the regulatory approval comes, basically, then you will commence or you will start the production. Right now, we are evaluating a situation that we want to transfer this factory to some third party on a lock, stock, barrel basis, whether this will qualify as a business or is it as an asset acquisition.
To my mind, I think it is still an asset acquisition because the business asset has not commenced. Necessarily there has to be, it is in process, right? And
But-
I'm not very sure whether the outcome is certain or uncertain.
Okay, so it will qualify
business,
it.
sir.
It is a business basically, and the reason for that is that whether there is a production happening or not is not one of the criteria. There is input in terms of the factory, the land and everything which is there. There are processes, there are certain employees which are there who has created the processes. There is an ecosystem in place to produce an output. Though they are not producing the output for the purpose of certain regulatory hurdles, but there is a process in place to create or to produce an output. And hence, when you are thinking to transfer that or acquire that business, it will qualify as a business and not as an asset. Hope this
But
is
all
very
this will
clear.
hold good. All this will hold good when the outcome is certain that it is only a timing difference where the process of receiving the approval is only formality that needs to be completed. But if there
No,
are other factors like where you are actually in a business where the government approvals whether they are going to receive it or not, that as uncertainty, if there is an element of uncertainty that exists, then I think we cannot call it as a business acquisition. And
no, it will. No, so whenever there are regulatory uncertainties, it does not form part of accounting standard. So let's say without any regulatory uncertainty also, had this factory been closed for operational reasons, for funding and everything, and somebody was acquiring it, will your answer still be the same that this is an asset acquisition? Your
I'm sorry,
answer
sir,
will not.
I
No,
had a
not-
network issue.
Kusum, sorry to disturb. Okay, let us take the questions at the end. Okay, let us continue the session. Okay, the presentation.
Sure.
Sure, sir.
Okay. So coming to this question, who can do the valuation under Ind AS 103 or who can do a PPA exercise? So there are two views which are possible and which is going around in the market. Basically, my view is, so one is that advisory services firm or anybody can do basically a valuation for a PPA. But in my view, it is basically that a registered valuer has to do it. And why do I say so is because Ind AS stems from section 133 of the Companies Act, and de facto a registered valuer is required to perform valuation exercises under Companies Act. So technically a registered valuer has to do a purchase price allocation exercise. But I have seen in the market that people adopting a view that this forms part of advisory services because the Companies Act is not very clear or Ind AS is not very clear on that. Now, coming to what are the, how do you identify or how do you measure intangible assets? So the standard is very clear that it has to be contractual. Now, what do I mean by contractual? If there is a contract in place, then it is a full stop. You can value this intangible asset if it is measurable and there is enough data points available to measure those intangible assets. There is one more criteria which people look into, whether it is a separable. Now, what do I mean by separable? Separable means that there are no transfer restrictions on these intangible assets. It can be easily exchanged. It can be either licensed, it can be either rented, or it can be divided. So just to give you an example, if there is a customer list which is there, the customer list will form in, it is not a contractual right, but it is a separable right because you can separate and you can transfer those customer lists to a third party, to the acquirer, and which can have any embedded value to it. So technically a customer list will qualify as a measurable intangible asset. Intangible assets that do not qualify these two criterions are subsumed as part of the goodwill. Now, goodwill will also include certain future growth prospects for whatever amount. So let's say you have acquired an asset or a business for 100 rupees and you are able to allocate only 90 rupees. The 10 rupees is something which cannot be valued because it cannot be contractually identified or it cannot be separable. It can be assembled workforce or future growth prospects which you have paid today. that will form part of the goodwill. So this is a flowchart just to simplify as to how do you identify an intangible asset. So I'm just repeating in terms of the flowchart as to how do you look at it, as to identify that. So first test is to determine whether there is a contractual criterion or not. If there is a contractual criteria, then definitely you have to measure the intangible asset at a fair value. If there is no contractual criteria, you move to the separability criteria. In a separability criteria, if that can be, there is a restriction on the transfer, then technically you cannot. If there is a restriction, then you cannot measure the separate intangible asset. But if there is no restriction on the transfer and everything, then definitely you can measure the intangible asset at a fair value separately. Now, what happens in terms of the assembled workforce? So there is a specific carve out in the assembled workforce that the assembled workforce does not meet the contractual or the legal criteria, as well as the separability criteria, and hence
I have one question.
So just a minute. So technically, in the Ind AS, there is a carve out that assembled workforce will subsume as part of goodwill. Though we value assembled workforce to determine the cross charge when you are using a multi-period excess earning method, but there is a carve out in the Ind AS to not record this assembled workforce as part of an intangible asset, and this value is subsumed in the goodwill. Yes, sir.
Exactly what is the assembled workforce? Is it an employees of the organization?
Yeah. So the employees which you are transferring, basically, that is the assembled workforce. Now, in terms of why the logic behind not recognizing this assembled workforce shall be that these employees are at their free will, though there is an individual contract, collectively there is no contract to bind them. And hence it does not meet a contractual or a legal criteria. So you are correct that whatsoever employees you are taking over as part of the business, those form part of the assembled workforce. Does that answer your question?
Yes, thank you.
Okay. Now, there are certain intangible assets which are classified under different buckets. This is not part of the Ind AS, but this is part of the International Valuation Standards and ICI Valuation Standards, which ICI Valuation Standards again are adopted by IBBI. So technically it is applicable to all the registered valuer, basically individuals and entities. So there are 5 buckets which have been identified in the International Valuation Standards, as well as the ICI Valuation Standards, as you may call it. So the intangible assets fall under these 5 different buckets. One can be marketing related, and those that I have highlighted are something which are regularly used for the purpose of our PPA exercises. So the trademarks and the trade names basically will form part of the marketing related. Again, just a clarification, whether it is forming part of marketing or customer or artistic, it does not matter basically. But the idea is to see whether they will qualify as a contractual or a separability criteria. So when there is a trademark or a trade name being valued, usually it will be a registered trademark. So there will be a contractual criteria which will be satisfied. So in that sense, there are many which are hypothetical examples, which are like an internet domain name. Again, it will be a registered, and hence it should qualify a contractual criteria. If we come to the customer related intangible assets, as I mentioned, a customer list is not a contractual right, it's a separable right, and hence it will qualify a separability criteria. If there is an order book which is there, an order book is a contractual right, and hence it will be a contractual criteria which will be there. So these are confirmed order books which you can value. Customer contracts, if there is a contract which is there, technically it will form a contractual, it will satisfy a contractual legal criteria. And if there is a relationship which is there, a relationship, there will not be any contractual criteria, but it will qualify as a separability criteria. There are artistic related, but basically if you are valuing the TV rights, if you are valuing certain artistic paintings and all, then also it can qualify a contractual or a separability criteria. These are basically contract based. So one which we usually use is a lease agreement, where there is a favorable or an unfavorable lease agreement or a non-compete agreement. And we will look into it as to how it has to be valued. But those all contract based will qualify in terms of satisfying the contractual criteria. And there are certain technology based, which is the patented technology or the R&D work or an unpatented technology. And unpatented technology will not be a registered patent technology, but it will be a separability criteria which will be qualified. So far, so good. So we move to the next point.
Yes. I have a question.
Yes, sir.
So related to your previous slide, you have mentioned the R&D, research and development. So basically, if there's some companies into research and development, so what is the criteria that we can recognize that as an intangible?
What is the criteria that you can recognize as an intangible?
R&D as a intangible.
So
how can
R&D will depend on the stage of the R&D. So let's say if you are developing a product and which is a pharma-based product, and in terms of the formulations, you have completed phase 2 trials or phase 3 trials, that can be recognized in terms of an intangible in the books of accounts for the acquirer, using various approaches. And when we come to the approaches, we will take it up. But technically, an R&D work which has been done up till date, and when you are giving a purchase consideration for that, the standard allows you to recognize this R&D on part of the separability criteria.
Okay.
Now, what method will fit to value the R&D will depend. And if you cannot get the data, then technically you cannot do the valuation of an R&D, and then that will be subsumed as part of the goodwill.
Okay. And trademark which are not registered, so can we add in, because ultimately it is just that it is not registered, but the client, they are commercializing it using the trademark. So is it identifiable intangible?
But then there is an infringement or the copyright which will be there. So technically, I have seen unregistered trademark being valued, but then the value will be minuscule. It will not be like major value which is attributed.
Absolutely.
So let's say if it's an unregistered trademark, then technically it is not a very dear asset to the company also. And so in terms of, you are talking about the B2B businesses where many of the trademarks are not registered.
Yes.
So like an HUL, whatever will be the trademark, they will not have an unregistered trademark. But a small local vendor, a mom and pop shop, will be an unregistered trademark. So technically the trademark can be valued, but the value of that trademark will not be substantial in terms of the overall purchase consideration.
Yeah, absolutely. So I'm not talking about value, but as a value, for example, using the cost approach, if you want to value it, just to allocate the minuscule value. So is it possible?
Voice is not audible.
Now,
you are saying using a cost approach. I could understand that.
Yeah. Using a cost approach, if we just want to allocate the value to the unregistered trademark, so that is fine as a valuer.
I would not agree to value trademark using a cost approach firstly, because so as a valuer, how would you do it? You would say that this is the time and effort which is required to obtain this trademark in terms of the registration processes and all, and that is the value that you are attributing. See, cost approach fundamentally is not a correct approach, and it can only be used for valuing some internally developed softwares and but because you don't consider the future outlook of that trademark in terms of the commercialization and all. So we'll debate on this when we move to the what are the methods to value. So in terms of the steps, so what are the steps one needs to usually follow in terms of undertaking a PPA exercise is you have to identify who is the acquirer and what is the acquisition date. Now, many a times I have seen that this acquisition date is a challenge if there are multiple dates which are there in terms of the agreement and when the closing is happening. So the acquisition date will be very important technically because that is the date when the risk and rewards of the businesses has been transferred to the acquirer. Second is the step 2 will be to analyze the information which is obtained in terms of the business transfer agreement or the shareholders agreement basis. What is the commercial nature of the transaction? You have to measure and recognize the purchase consideration. The PC, determining a PC is also certain times a nuance because there are contingent considerations which are attached to a purchase consideration. There are deferred consideration which is attached to a PC. There are certain indemnifications which are provided. So how do you determine a PC will also be is a very important step, because if the PC is not correct, ultimately the answer or the goodwill amount which you are trying to analyze will not come out correctly. You evaluate the PFIs. What do I mean by PFI is technically the deal projections. And what do I mean by deal projections is that you have to look at the market projections in terms of when you are acquiring the business. Ideally, we determine the IRR. And to determine the IRR, we take the deal projections or the management projections without taking the synergies which the acquirer's management is going to bring on the table. And from a market participant point of view, what should be the business plan looking like? So you evaluate the PFIs to determine the IRR. So as I mentioned, the step 4 and 5, you have to evaluate the implied IRR based on PFI. You recognize and measure tangible assets which are acquired at fair value. You recognize and then measure the intangible assets, and whatever is remaining will be allocated to goodwill, or it will be an otherwise which will be a gain from bargain purchase. The second last step will be to analyze the WACC, VARA and IRR, whether that is falling in range or not. If it is not falling in range, it is required that you go back to the drawing board and determine why this is not falling in range. And the last step will be to prepare a PPA report. Now coming to the acquisition date, as I mentioned that technically what happens is that whenever the risk and rewards are getting transferred to the acquirer, that is the date as per the Ind AS also when the business combination standard gets triggered. And hence the accounting is required on that particular date itself and not on the signing of the BTA or not when the transactions have started place. Coming to the acquisition cost. So usually what happens is that acquirer would have incurred due diligence cost or valuations cost or XYZ in terms of getting this entity on board. So Ind AS is very clear that whatever are the pre-deal costs, that should not form part of the purchase consideration. So ideally, whatever is the legal or cost which is incurred will never form part of the purchase consideration. Now to determine the PC, as I mentioned that purchase consideration to determine is of prime importance, because if your PC is not correct, technically your goodwill or the bargain purchase amount will not be correct in terms of the accounting. And there is a concept of a deferred consideration and a contingent consideration. And anybody from the audience who would like to explain us what is a deferred or what is a contingent and what is the difference between those two?
Deferred consideration is a consideration which is agreed to pay at a later point of time, with amount is agreed. Contingent consideration is where additional consideration based on certain milestones will be paid by the acquirer to the acquirer.
Agreed. Thank you so much. So as sir mentioned that it is exactly the same. Contingent consideration can be based on certain milestones in terms of, so you usually call it as earnouts. And this can be based on achieving of certain EBITDA margins or EBITDA numbers, or achieving certain SKUs, or getting a patented product, or registering of the brand, and within a certain time frame, then you will get X times of the revenue multiple or X times of the EBITDA, etc., will form part of the contingent consideration. In terms of the deferred consideration, that amount is fixed, and it is just that the time gap is there, that it will be given to as part to the seller as part of the deal within a period of 6 months or 1 year or 2 years. And technically, there is also an indemnification asset or a liability, which usually we would have seen in the deal. So let's say if there is a court case which is going on, and technically the view is not sure as to whether the outcome will be in the favor of the entity or it will be against it. So certain assets or the liabilities are indemnified by the seller, that if this amount is recovered or if there is a liability, then technically you make good that liability. So it is a pass-through. It does not require any adjustment to the purchase consideration, but one has to be mindful that whether in terms of when you are going through the BT or the shareholders agreement, you have to be mindful about those assets or liabilities being there, because what will happen that the acquirer is going to account as an asset as well as technically a liability, because if he is recognizing that as an asset, and if that amount is recovered, there is a corresponding liability in the books of accounts for that. Okay, so let's take some illustrations to identify whether the particular case is a contingent consideration or an indemnification asset. So the first case is a retention bonus, which is paid to a key managerial person of the acquiree if they continue in service for 2 years after acquisition. So whether it will be a contingent or an indemnification asset, what is your view?
Contingent.
Anybody has another view on indemnification asset?
Looks like contingent only.
Okay, so if so, I just to make it a little bit simple for you. So let's say there is an employee and who is a key managerial person. If that person continues in service, in terms of will that form part of the contingent consideration? Ideally, ideally it should not, because it is pertaining to an employee and not to the acquirer. You see, we are technically debating between, let's say, if the acquirer, if the seller of the business is again an employee, and there is a condition that the seller has to remain in service for 2 years, it is not a contingent consideration.
Okay.
So it is neither a contingent consideration nor an indemnification asset, because this is a service basically as part of the employment agreement that he has to be part of, continue to provide the service for 2 years after acquisition. Let's take next example, adjustment to consideration.
Essentially, you're saying that the money is being paid for that only, correct? So it's specific consideration, correct?
The money is being paid for his to be part of the employment service, and you will be rewarding him as in terms of the salary.
Correct. And if he stays there, the company.
Sorry, I missed the last part, Mr. Gupta.
Yeah, if he stays, then we are paying this value to the company, correct? So therefore, it's a specific consideration.
But we are paying not as part of the purchase consideration, sir. It is being paid as part of the employment services which he is going to provide, and hence it is not forming part of the purchase consideration.
Okay, retention bonus, because it's term-based retention. Okay, got it.
Adjustments to consideration depending on the future production capacity. What should that be?
Contingent.
Okay, that's correct.
Contingent.
Earn-out agreements.
What does it mean? Please explain.
Contingent.
It forms earnout agreements basically is contingent, as I was mentioning earlier. So, lawsuits or reimbursement payments.
Indemnification.
Indemnification.
And the last one, the reimbursement of uncertain tax positions.
Indemnification.
Indemnification. What is earnout agreement, just for understanding?
So basically earnouts is, as I was mentioning, it depends on achieving of certain milestones. And based on that, you will decide as to what should be the payment which should be made. So usually when the buyer and seller are not in terms of the agreement, in terms of the valuation, they park certain amount saying that this will be paid in the future date, depending you achieve this numbers.
Okay.
Yeah, Bhavik. Okay, so
Just one clarification. See, point number 5, uncertain tax provisions. So if it is disclosed as kind of contingent liabilities, then it becomes an indemnification asset, or you had made certain provisions in the books. Can we consider it as contingent consideration?
It will not be forming part of contingent consideration, because what will happen is that there will be a carve out in the agreement, whether it is a contingent liability or whether it is provided in the books. Technically, you will be, if there is an additional liability which comes up, or let's say if you win the case and that liability is already paid under protest, but you recover that amount, the seller is going to ask that amount from you. So it is not part of the contingent consideration, it is part of the indemnification. So you are not going to top it up with certain things and then pay. It will be a paisa to paisa amount which will be reimbursed.
Thank you.
Okay, so just quickly, I think we are just running late because I have to cover many things. So just quickly, I have taken an example as to how the purchase consideration, or a case study as to how you usually do determine the purchase consideration. So here in this example, if you can see on the screen, the cash consideration is around 170 crores. There is a deferred consideration, and I took this example specifically to cover the deferred consideration. So the deferred consideration is 100 crores, and these are the milestones for the payments. So usually what we do is that we bring this to a present value terms, and to determine to a present value term, the rate of discount that we use is a risk-free rate plus a credit spread of the acquirer. So technically the 100 crores present value will be 81 crores, and that will form part of the purchase consideration. Is this making sense? Because 100 crores, a milestone based payment in 3 years or 2 years on a present value terms, when you are acquiring in the books on the business combination date, that dollar is going to be not worth $1, but less than $1's value. So technically my purchase consideration for allocation will be 251 crores in this example. And there are certain indemnification assets and liabilities. So technically there is, in my case, there is 25 million of indemnification asset. Correspondingly, there will be a liability which will be created in my books. So my business enterprise value will be 251 crores, assuming there is no net debt or surplus assets.
but Bhavik, don't we have to consider the probability of happening this event?
Sir, this is a deferred and not a contingent. So there is no probability.
Okay, deferred. Okay.
If it was a contingent consideration, then yes, and you use a probability weighted average model or option pricing model to determine this 810. But this is something which you have to pay, and the amounts are determined. This is just that you are bringing this to a present value.
Okay.
So the next case study is basically that you are acquiring.
Question, sorry, on the deferred consideration, not sure if I missed, if you explained, why would there be a deferred consideration? What is the example?
No, you as part of the commercial, you might deal that I'm going to pay you 100 rupees today and 50 rupees 2 years down the line. It's part of the commercial. There is no reason for having a deferred or a contingent consideration, right?
Okay, fine.
So just one more quick question on the previous slide. If you
Yes,
could the previous slide, please.
I'm on the previous slide. This
Yeah.
is the case study, right?
Yeah. So note one is fine. Note two, you had done both addition and then subtraction as indemnification liability. So
Okay.
indemnification by nature would be an amount payout. So it
What
involves liability.
so
Yeah.
so Rajesh, just assume a scenario where you are acquiring a business and the business has these two items. One is a lien on FD and second is an EPCG claim liability. So in the books of accounts, there is an asset of 39 and there is a liability of 40. So technically you are acquiring this 25 as an asset in your books, but there is a condition that if any of this thing materializes, so technically when you receive 39, you have to repass it to the seller. So in your books of accounts, you are going to recognize this 39 ke samne, you are going to say that 39 is my liability, and this 14 ke samne, you will also recognize a corresponding asset, because this is something which will be reimbursed if there is an EPCG claim liability which comes in the future. And hence, there is an adjustment of this negative 25.
Okay, thank you.
So as I mentioned that indemnification asset and liability are just passed through for the books of accounts. It does not affect the purchase consideration. Okay, coming to the next case study. So in here, there is a 60% cash consideration to acquire 60% of the stake, and subsequent to this, there is an amalgamation which is announced with the target, saying that if the amalgamation is not consummated or is not passed or approved by the NCLT, then acquirer shall have a right to acquire the balance 40% stake at the same price at which they acquired the 60% stake. So technically, the point which I'm trying to say is that if 60% is acquired at 270 crores, and for the balance 40%, to determine the purchase consideration for 100%, what we, and this is a case which we have done. So this is in this, what we did is basically whatever were the shares proposed to be issued for this balance 40% multiplied by the price which was trading in the market on that particular day, we determine the PC for 100% of the stake. Okay. Now let's come to the methods which one has in terms of valuing the intangible assets. More or less pretty similar to value the businesses as to certain methods that we use. And primarily the methods that one would use is the income approach. In the income approach, there are 5 methods which are defined, basically a multi-period excess earning method. Now, multi-period excess earning method is just an extension of a DCF, and how do you apply it, we will see. There is a relief from royalty method, and there is a with and without method. Now, multi-period excess earning is an indirect method, but relief and with or without is a direct method technically. There is also a distributor and a greenfield method which are defined, but practically I have not seen usage of these two methods for the purpose of valuation. We will cover the 3 methods which we are talking about, the multi-period, relief, and with without, in detail in the upcoming slides. Under the market approach, usually comparable transaction method is also used, but again it has a limited application technically when there is a brand which is traded isolated in terms of, let's say, an FMCG brand or a pharma brand. If it is traded and there is a transaction multiple available, then that multiple can be adopted and applied for the purpose of valuation, but it is again seldom used in terms of the want of the data. So practically the comparable transaction method also has limited usage when you are valuing intangible. for cost approach, as I was mentioning, that we have two methods. One is the reproduction cost and the next is the replacement cost method. But it does not have any connection to the future financial benefits. And it is usually used to value assembled workforce or certain very less valuable intangible assets like an internally generated software or a third-party software which has been developed, but which are not monetized by the companies. Now, what is a relief from royalty method? So we'll just go quickly over here. In terms of, yes, Siddharth. Sorry, you had some question? Okay, so coming to the relief from royalty method, what is a relief from royalty method? A relief from royalty method usually says that what is the hypothetical royalty payment that you are saving since you own this asset. So think of it from that perspective, that if this asset was not there with you as the owner, then you would have either taken this asset or you would have taken a right to use this asset. And when you would have taken a right to use this asset, you would have paid some royalty. So the royalty which you are not paying to use this, or a right to have a right to use this asset, is something which you are in a way saving on a net of tax basis. When you discount it, will give you a value under a relief from royalty method. Now, ideally, this is used for valuation of brands, trademarks, and technical know-how or certain IPs. So how do you apply it? You estimate what is the royalty payment which you are saving in terms of the revenue. So usually you estimate the revenues. Let's say you are saying that 3% is the royalty payment, then 3% is on a net of tax basis will be the savings in terms of the royalty payment for maybe 7 years, 10 years, depending on the life of the asset that you are considering. So if it's a brand and and again, the life is a subjective thing for a valuer to decide as to how do you determine the life of the asset of an intangible. We will cover that also as part of how do you determine the life and what factors should be considered. But hypothetically, let's say for 5 years is something which you are foreseeing that you would have saved the royalty on a net of tax basis. When you discount it as using a risk-free adjusted discount rate, that will give you the value of the value under this method. Now, there are certain databases such as Royalty Source, Markables, which give you, and these are all paid databases again, which give you an royalty rate based on the industry, based on the sub-industry classifications. And they also give in terms of whether it's a PPA deal or a license deal. And they give you a range also as to it should be in the range of 1 to 5% or 1 to 2% or 5 to 10%. Again, there is benchmarking study, which usually we do. If it's a related industry, in a related industry, what is the royalty rate which is going on to give a sense that the royalty rate that we are using is not far from the market participant point of view. So coming to the next method, which is a multi-period excess earning method. As I mentioned, this is a variant of a, it is a variant of a, sorry.
SEC filing? What is SEC filing?
SEC filing, like you have a BSC filing in US, you have SEC filings.
Right.
So in SEC filing, usually the disclosures are very stringent over there, and they determine what is the royalty rate and everything. So we do benchmarking study through companies which are listed on the US stock exchanges or Indian stock exchanges also. Coming to the meme method, the meme method is again a variant of a DCF method. So usually what we are trying to do is we are trying to determine what is the value attributable to a particular asset or a particular intangible asset. Now just to give you a simple example, today when you are doing a DCF, the EBITDA or the EBIT that we consider is a function of all the assets, the tangible as well as the intangible assets which we put to use. from that, you have to reduce the charges which are related to the tangible assets and the working capital and the assembled workforce to determine that this is what is the contribution by a particular asset. So let's say if you are valuing customer relationship using a multi-period excess earning method, for achieving that EBIT margin through the projections, there is a function of tangible assets, the PPE which is put to use. There is again working capital which is required to be blocked to achieve that kind of an EBIT margin. And there is a function of assembled workforce also. Again, if you are valuing other assets like a brand or certain non-compete or everything, then all those assets also come into play to determine that EBIT margin, because you are just trying to determine what should be the profit attributable to a particular intangible asset or a cash flow attributable to a particular intangible asset, which is customer relationship. So what are the steps you do to determine this? One is you determine what is the EBIT, you reduce the taxes. So you arrive at the free cash flows before contributory asset charge. You reduce the contributory asset charge for tangible and intangible assets. So like intangible asset, as I mentioned, if you are valuing brand, then for that brand, whatever is the cross charge, you will reduce from here to determine that this is the free cash flows which is attributable particular to the customer relationship. You discount it at the risk adjusted discount rate to determine the present value of the free cash flows. You add the tab benefit and you arrive at the fair value of the intangibles. Coming to the last method for the purpose of discussion is the comparison. It is the incremental cash flow method, also called as a with or without method. Now, usually this method is applied for valuing non-compete agreements. Also, it can be used when you are valuing relationship or a distribution network. So think of this method in terms of a non-compete, because it will be very easier to understand what is this method all about. In terms of a non-compete, what are we trying to say? That if I have a non-compete agreement in place, then this will be my revenue, this will be my profitability in terms of the operations. If I did not have a non-compete in place, so technically if the seller was going to compete with me the very next day, then what would be my profitability situation looking like? The difference between the two on a present value terms is the value under this method. So having a non-compete agreement in place is going to give me a value of, let's say, 5 rupees, 10 rupees. So the differential value is the upside of having a non-compete agreement, which is the value attributable to a non-compete agreement. So what are the steps? Determine the free cash flows under a which scenario and without the scenario, and calculate the difference. The difference has to be present valued using an appropriate risk adjusted discount rate, and you again add the tab benefit to it to determine the value of the intangible. Now, what is a tax amortization benefit? Now, I was in all the three methods, I was saying that you add the tab once you determine the present value of the free cash flows, basically. So tax amortization benefit is again an hypothetical premise. What are we trying to say? That there is a step up available in the tax books of accounts whenever you are acquiring that asset, and hence you add that step up as part of the valuation. So can somebody mute? Somebody is unmuted. And yeah. So there are certain jurisdictions where a tab benefit is not available or a tax step up is not available, and hence a due care should be taken whether a tab has to be added to the fair value of assets or not to determine the fair value of asset after tab. Again, care should be taken when you are applying income approach, then only a tab benefit has to be added and not under a market or a cost approach. If you are using a CTM method, hypothetically, whatever is the tab which is there is already subsumed in part of the multiple that you are arriving at, and hence a tab is not required to be added separately, otherwise it will lead to double counting. In India, ideally, I have seen different practices adopted by practitioners. So technically, when it's a slump purchase, usually you add the tab, but whenever the deal is through an equity, and if you're acquiring more than, let's say, a controlling stake in some of the companies, auditors usually don't allow to recognize tab as part of the fair value because there is no tax step up which is available as part of the equity purchase. But if we strictly go by the IFRS or the Ind AS is very clear that tab has to be added to this to determine the fair value of the intangible. And the tab factor is usually 18 to 20%. So it's a significant portion of the intangible, the fair value of the intangible asset. Mr. Shiva Prasad, you will have to just mute yourself, please.
So Bhavik, for each and every intangible we are going to allocate some value, we need to identify whether the depreciation under the tax would be allowable for that particular intangible. And if it is available, then only we can add the tab into that. Is the understanding correct?
Ideally, sir, this is what is followed by the practitioners in India. So what practitioners do is whether it is a slump purchase or a equity purchase. If it is a slump purchase, usually they recognize tab. If it's an equity purchase, they don't recognize tab. But if we go strictly by the IFRS, then it says that tab has to be part of the fair value of the intangible asset. And technically it is correct also because let's say if you are acquiring an asset, let's say you are acquiring a business and business only has one intangible asset, which is a brand. So the brand value is not going to change whether it is through a slump purchase or whether it is through an equity purchase. So आप ये नहीं बोलोगे that अब slump purchase है तो the value is increased by 20%, and if it's an equity purchase, the fair value of the intangible is less by 20% also.
Right.
No, so for example, some of the asset like customer relationship or assembled workforce, for those kind of assets, the tax is really questionable, whether the tax depreciation would be allowable or not. So whether we need to consider that or not?
No, sir. Customer relationship, why do you say so? Because there is a mixed opinion on that. There are certain tax jurisdictions or rulings which are available, then the relationship has been allowed also.
Okay.
But assembled workforce any which ways is not allowed in tax as well as in accounting standards also.
Yes.
But ideally, as part of as a valuer, I don't see whether that particular asset is going to be allowed under tax and then determine whether a tab has to be applied or not. When it's an equity purchase, and if it's a major value which is allocated, I have sometimes in the past not allocated tab because the resistance of the auditors for not allowing to recognize tab. Okay.
Okay. Thank you.
Now,
Bhavik, you mentioned in CPM method we don't use that. So what is that exactly? If you can list that, tab is not
so
applied.
the comparable transaction is something. Let's say, let's say if there is a Parley brand, which is again an FMCG brand, if that is being acquired by someone, so like Bisleri, some time back we were all aware that Tata was going to acquire Bisleri brand or something. So that whatever is that multiple, the revenue multiple which you can determine, that is basically applied, that same multiple is applied to your subject intangible after adjusting for certain qualitative factors.
Yes.
So usually you don't find such kind of multiples which is readily available. So let's say if you are valuing some other trademark or some other brand which is not in the FMCG or not in the pharma space, then how do you apply that kind of a method? Because these are not traded assets where you will find because seldom a brand is being sold. And usually I can see an example in pharma industry only that a brand will be sold separately. Otherwise, there will be a business transfer which will be happening. And when there is a business transfer which is happening, usually you will not be in a position to determine the value to it as to what multiple you can determine. Are you with me?
Right.
So that is the reason I mentioned that this is not frequently used, but for certain select industries, if you come across a multiple, then yes, you can apply that. But care has to be taken that you have to adjust the multiple for certain subjective factors, like the size and the growth, which you are comparing of the transaction with our brand or when you are valuing.
So we are saying essentially it is factored in kind of in this situation, correct? Because
yeah. So when you are trying to determine, okay, so coming to your question now, let's say Bisleri was being acquired at 2x of the multiple.
Correct.
Now the 2x will definitely include the tab benefit also. So if you are applying the 2x multiple of it, if that additional 20% or so for the tab, then it leads to double counting. That is what I was trying to explain.
So market
when you are
tab, and when we are doing a DCF approach or the other approach, in that situation, we have to add the tab and then
you have to add the tab, right?
Evaluate. So that's a kind of unwritten rule, if we may call it, correct? Typically.
Yeah, that is correct.
One request for the organizer: there's someone who is there's a background noise which is coming. If that can be mute, he can be muted from your end because he's unable to mute. Looks like.
If you tell me the name, I'll mute him.
Just one second. I think this is Rajendra, if I'm not mistaken.
Rajendra Sanghi, Mr. Sanghi.
Yeah. Mr. Rajendra Sanghi. Yeah.
Done.
We can mute him. Correct.
Okay. So coming to the economic life, and this is a very important aspect. Seldom we are in a tough situation as to what should be the life of the intangible asset. Now there are many qualitative factors one needs to consider. And just to take a simple example, that let's say if I'm valuing a customer relationship, as Sir was mentioning previously, now what has been the attrition pattern? So when you are valuing a customer relationship, you are valuing today's customer and not the future customer. The future customers which are going to be onboarded is not something which you can value as part of the relationship, because the relationship is with today's customer, and that is going to have an attrition over a period of time. Now, when I'm looking at the attrition rate in the previous historical period, that same attrition rate can happen. And based on that, I can determine the life of that customer relationship. There is usually sometimes a very sticky attitude of the customer also. So there is inherent stickiness when you are determining a valuation for a customer relationship. Then technically we try and determine that 10 to 12 years should be the life. Beyond that, whatever you do, because of the discount rate that you use, that the value from beyond 10 years will be very minuscule. Again, this has to be understood that for the purpose of economic life and the accounting life of an intangible can be very different. For valuation, let's say you are taking 5 to 6 years, but for the period of accounting, auditors may insist that you take a lower life and you amortize that within 3 years or 4 years, basically. So there is two different concepts: what is the economic life and what is the accounting life. There are certain things which needs to be, so let's say when you are valuing a technical know-how, then what stage, whether there is an advancement in the technical and there is technological obsolescence in the asset that you are valuing has to be seen, and how frequent the technology is changing. But in terms of technical know-how, basically the ideal life one has to consider should be not more than 4 to 5 years, because that is the rate at which the technology is changing today, and there will be a major revamp which will be required in terms of the technology that we are in today. But again, this is very subjective. Everybody has to take their own judgment call. depending on the facts and circumstances of the cases. If it's an patented product and going off patent, then certain legal, regulatory or contractual limitations will come into play to determine what should be the life that one should consider. What is the product life cycle, whether it is at the declining phase or whether it is at the growth stage, will also help us in determining what should be the life that one should consider. But anything beyond 5, 6, 7 years is something which will be required to be justified with more armors under our belt, basically, because beyond 7 years or beyond 8 years is something which ideally I am not comfortable valuing an intangible. Unless it's a brand which is existing, like let's say a HUL brand or something. So then definitely the life will be more. But apart from that, I don't foresee that any intangible asset has more life of more than 7 to 8 or 10 years per se. Now, what is WACC, WARA and IRR reconciliation? So again, this is a beauty of a purchase price allocation when you are doing. And let me be very candid about it, that in the first attempt, I don't get WACC, WARA, IRR, which is reconciled. And again, I have to go back to the drawing board as to what am I missing or where am I making some error. Now, as everybody understands that IRR is something which is an implied rate of return based on the projections that you receive. And that IRR, you compare it with the WACC. Now, what is WACC? Let's say if it's an industry in a pharma space, then what should be the ideal discount factor which one should use? So if IRR and WACC is equal, then technically it means that market participant assumptions are used and it represents the fair value. If IRR is more than the WACC, then one has to be very sure that are there any signs of a bargain purchase being there, or are there any entity specific, like I am the acquirer and I am taking care or I am incorporating certain entity specific synergies into the projections. And because of that, my IRR will be on a higher side as compared to the market WACC. If IRR is less than the WACC, then there will be a situation when there is a conservative bias or the projections are on a conservative basis. There is some impact of the market participant synergies. What do I mean by market participant synergies is that, let's say a rent, I'm taking a simple example. Let's say a rent in a particular area is 100 rupees. And technically the rent which I am paying to a related party is 50 rupees. But hypothetically, if it was to a third party, I would have paid 100 rupees. Then as part of the projection, the PFI which I am making, I should have considered that additional cost of 50 rupees. That is what I mean by market participant synergies, and not because of the favorable or the unfavorable agreements which are existing as on date. So, and what do we mean by a VARA? So VARA is basically a function of all the assets which we put to use. Now, if you look at the chart on the left-hand side, and I'm just putting the pointer over here. So the net working capital are the assets which require the least returns. And then will come the tangible assets. So a business requires net working capital, tangible assets, identified intangible assets, unidentified intangible assets, which is the goodwill. So the required rate of return is based on this, basically. So the net working capital will have the least expectancy in terms of the required return, and the unidentified intangible assets will have the highest rate of return. So technically, all these assets put to use will give you a weighted average return, which has to be equivalent or near about the WACC and the IRR. Is this clear? So coming to the last two sections of my presentation, before considering the case study, let me take you through the PPA report as to what usually are the contents in the PPA report. And Sir had set the context right, that there is too much of scrutiny which is happening, and one has to be mindful and should not deviate in terms of the disclosure perspective which is required in the report, because there will be additional nuances attached to this. So usually we cover the background, and I will just explain you what are the critical points. Otherwise, these are certain things which everybody will be doing in their day-to-day practice. The background, the scope, and the purpose. The scope and purpose has to be spelled out clearly, that this is the valuation which is done as per Ind AS 103. Certain paras of the Ind AS 103 is something which we put in the report when we are determining the goodwill, or when we are determining certain intangibles. We also provide the financial overview, which is the historical overview of the business or the company. What are the sources and the procedures which are adopted? What is the basis methodology? So here, a care has to be taken by all the members, basically, that we should mention what approach we are not using also, and what is the reason for not using that approach. Because ideally, you cannot just say income approach, I have used meme method. Why are you not using the other method is something which one has to explain. Identification of assets and liabilities. Again, here what happens is that, let's say in intangible asset, there is only brand that you are valuing, but other intangible assets which you have tested, like relationship, customer contracts, non-compete, why you are not valuing those intangible also has to be forming part of the reports in terms of the study that you have done when you are determining or identifying the intangible asset that has to be valued. So let's say for non-compete, a simple reason can be that there is no non-compete as part of the BT or as part of the SHA, and hence you are not valuing it. Or relationship, the business is such that there is no relationship which is there, like a B2C business. Okay. And goodwill. So for the goodwill, as I was mentioning, that we also mentioned the para or the carve-outs from the Ind AS as part of that. We also provide the exhibits which are part of the report, and detailed working under the meme method or any other method that we have adopted. A WACC, VARA, and IRR reconciliation is given, that this is falling in range, and this gives an additional comfort to the auditors also. And the conclusion. And lastly, in terms of the caveats, disclaimers, and the assumptions, one disclaimer, everybody will have that their own set of disclaimers, but one caution which is required is that when you are relying on the work of the expert, let's say hypothetically for if you are not a plant and machinery valuer or a land and building valuer as a registered valuer, ideally you are relying on the work of the expert, because you are going to adopt that same values for determine the goodwill. So PC will be attributable to plant and machinery and land and building, and then will be attributable to intangible assets. So you cannot disclaim that this is something which I have not reviewed, or this is not my part of scope of work. When you are adopting that value in your report, it is something that you should analyze the procedures, you should analyze the formulas, information, and the procedures which are used by the expert. So you are not allowed to disclaim your liability that this is work of the expert and I am relying on that expert, is something which is onerous on us as part of the valuation. But this is required, and this is need of the hour, that because we have also started going through the valuations of land and building and plant and machinery valuer in terms of the life that they are using, in terms of the replacement cost that they are using, and whether the formulas are coming out correctly or not. And that is the basic check that is required as part of the value PP exercise that is done by us.
Yeah, Bhavik, I have a question.
Yeah.
So related to your the reconciliation between WACC and IRR, so why is it particularly required to reconcile? Because in some situation, the buyer would have agreed to pay the additional consideration or premium to acquire certain business. Then why is it required to really reconcile the WACC and the IRR?
Okay, so and why would that situation be? if it's a fair market transaction, not a related party transaction,
Mm.
why would a buyer agree to pay
Because
a premium or
because they might be getting some certain synergy or backward integration so that the in their entire supply chain gets fixed up.
so then that should form part of the goodwill. Ideally, that is not allowed to be recognized. So let's say if I'm paying a premium for my supply chain initiative, ideally my WACC and IRR should match, but whatever is the additional consideration which I'm paying. So let's say hypothetically, I'm saying I'm banking on certain industry and I'm being generous and I'm offering in the market 8x is the multiple which is going on, but I'm being generous and I'm offering a 10x multiple. That additional 2x multiple should form part of the goodwill.
Absolutely.
So technically, your WACC and the IRR will match.
No, so what I understand is that, for example, if we undertake the DCF valuation and to arrive at the purchase consideration, whatever discount rate we need to arrive at, that is IRR, right?
Sorry, come back again.
For example, we have agreed the purchase consideration. We have the projected numbers. Okay, so by using these two numbers, we can arrive at IRR. However, the WACC would be the cost of equity and the cost of debt, right? So that is fixed WACC.
No, it will also change, no, sir, because when you are saying, so just taking a step back and moving to your example, when you say that you are acquiring or a business which is going to help us in the supply chain initiative, when you are building the projection from a market participant point of view, you will not consider that kind of a supply chain initiative under your projections, right?
Absolutely.
Because those are entity specific synergies and not market participant synergies.
Absolutely. Yes.
The moment you remove that from your IRR for arriving at that IRR calculations, basically your WACC and IRR is again going to match.
But my purchase consideration is fixed.
Again, so yes, your purchase consideration is fixed. Your IRR will come at a higher value, at a lower value, but your discount factor will also be adjusted to that an extent, no, sir?
Okay.
So when the idea is very simple. When it's a non-related and arm's length transaction, if there is an additional payment which is made or deduction which is made in terms of the purchase consideration while determining the purchase consideration, either it should form part of the goodwill or it's a bargain purchase. And that is the reason a WACC vara IRR reconciliation is required. I understand where you are coming from, that it is a commercial deal which has been agreed.
Yes.
But in that cases, then you have to adjust the answer to give you a simple answer.
Okay, got it.
To the question that they raised,
Rajiv, I'm not able to hear you.
hello. Can you hear me now?
No, your voice is
echo. Sir, can I?
Yes.
Sir,
So we just be mindful that within half an hour we have one case study to finish.
Yeah, sure. So before that is very important, I thought. This purchase price allocation, when we do this amalgamation merger, when we have to go for purchase price allocation, when we have to go for pooling method, the control, just if you can give some light on that, when we have to go for asset pooling method, when we have to go purchase price, that is point number one. Point number two is from the income tax point of view. So what is exactly the purchase price allocation when you do identify? When we acquire the company, WTF transfer company, we have to adopt, no? So what is how income tax is going to impact to the transferring company?
Okay, I'm not clear on the second question, but on the first question, the point you are trying to say is when you adopt a purchase method and when you adopt a pooling method.
Yes, correct.
So the answer is very simple. When there is a common control, holdco acquiring further stake in the subsidiary. So earlier they were holding, let's say it was an associate, at 40% or 30%, and then they are acquiring more than 50%, which brings control to them. At that point in time, since it's a common control, pooling of interest is required to be adopted. In pooling of interest method, the valuer's role is not there because everything has to be adopted at the carrying value. There is no concept of fair valuation, which is
It means that there are two things. If one is subsidiary holding company acquired subsidiary company, there it is 100% subsidy, valuation is not required. Second thing is associate company where we are holding 25%, then it has been acquired. So at that point of time, also whether pooling method is permitted.
Pooling is only required because it's a common control.
Only earlier we were holding 25%, but 70%
doesn't matter. Doesn't matter.
Pooling method is permitted.
Yeah, sir.
No, but in the first one, there is no control. No, I have only I have only 25% stake. It is significant
Agreed.
control.
Agreed. But 24% is an associate for you.
Correct.
The business combination standard applies only when you have a controlling stake. So hypothetically over here, it is more than 50%. From 24, you are moving to more than 50% or 50%. Let's say that time also you are the same controller. It is the group. It is the same group. When you are having 24% also, you can exercise control. So when it is a common control, technically you are not allowed to use purchase price method or a fair value accounting.
It is a book value.
Yes, sir. Coming to the second question of yours, in terms of, if I understood it correctly, let me reiterate. How would you account this in the books, in the tax books?
Yes, correct.
Yeah. So if it is a slump purchase, if it's an equity purchase, there is no step up which is available for the intangible assets. If it is a slump purchase, if it's a business purchase which you are doing, in terms of when you are filing the acquirer's return, at that point in time, whatever intangibles which are recorded in the tax, in the accounting books, are also recorded in the tax book. So let's say hypothetically brand, 100 rupees brand value is also recorded in the tax books at 100, and on that amortization is available. But if it's an equity purchase, it will again come as an investment only, and there is no change in the tax books. Is it clear?
Yes, sir.
Okay.
103 Ind AS and accounting standard 14 amalgamation. I think principle remains same one, though it is for a different set of companies are applicable.
Right, sir. It is same.
Bhavik, Sanjay here. Can you go to that slide where you got that VARA and WACC comparison? Yeah.
This one?
No, after that, the table. Yeah. So essentially, when we are doing a calculation, correct? Let's say that we are doing a valuation, we do a DCF market approach, and then we arrive at a value, correct? And we got the discount rate, which is a WACC, calculated cost of equity, cost of debt, and then we got a weighted. So now that is coming on the right side, debt and equity and the weighted cost, correct? So that gives me the WACC. Now we know the cost of debt, we know what is imputed for equity, and therefore we got a number. Now when we are doing purchase price allocation, we got the purchase price consideration and we are allocating into tangible, identifiable, and you said residual categories, unidentifiable or goodwill. Now net working capital, again we have a rate which equates to the rate at which I'm borrowing today. Intangible assets, I can impute the cost of loan or equity, correct? And intangible, we have to impute the cost of equity, let's say. So when we are doing a reconciliation, this last item becomes a balancing figure. How do we justify that?
The last is the goodwill, right? It becomes a balancing figure. It becomes a balancing. So when
rate also is a balancing figure, because all of these numbers have got weights, correct? So if I multiply net working capital multiply by the net working borrowing rate, correct, it will give me a value. Tangible
so
asset.
Mr. Gupta, if you can just park this question for my case study, this will be very clear after the case study. If there is anything, I will again take it up at the end of the session.
Certainly. Thank you.
Okay. So can anybody run the polling questions and then we can move to the case study, please?
Vijaya?
Please.
Vijaya?
Hi, yes, sir. Chandrasekhar, sir. Can we?
Good morning.
Yeah,
Yeah, Vijay,
please.
Vijay, can you run the
Okay.
poll question?
Hi, yes, sir.
So I think as per the IBBI requirements, we need to run the poll questions, and she will run the poll, and participants will answer their question. Vijay, can you run the poll number 1?
Hi, yes, sir. Yes, sir.
What is the question in this actually?
Yes, sir. What is the question?
Not clear. Question is not clear.
Question is not
I
there.
will just say what is the question. The question is that what should be the business combination date?
Maybe the entire question is not typed out.
So I'm clarifying it that the question is that what should be the business combination date?
Can you read out the question, sir? For benefit of just can you read that question?
I will read that. So it says X has acquired the division of Y, and the discussion initiated on 1st of January 22. BTA was signed on 31st of March 22, and there were certain closing adjustments, and the closing date happened on 31st of May 2022. The question is, what should be the business combination date on which a valuer has to do a PPA?
January or 31st March or 31st May? Vijay, if you got all the answers, then can you go to second poll?
Hi, yes, sir.
So, do I have to give the answers now?
Yes, sir. Sir, can
Okay.
you share the results, sir?
So most of them have voted for 31st of March. The answer is incorrect because the closing adjustments were pending for this, and the closing date is mentioned as 31st of May. That is the day on which the risk and reward is going to be transferred, and hence the business combination in the books of acquirer will happen on 31st of May and not on the signing of the BT.
Fine, sir.
I think most of us took the 31st May as a NCLT approval date or something. So that's why
There is NCLT coming into picture. Sorry.
Amalgamation, if it is the scheme, no? This scheme is not. Okay, sir.
Okay, we move to the next question. No, this is again the first question which has come up.
Vijay, this question is over.
Hi, yes, sir. Just give me a minute, sir. I will.
Yeah. Okay. So the question is that under which valuation method the valuator has to adjust for contributory asset charge on tangible assets and working capital, variable transaction method or replacement cost method.
What is CAC?
Contributory asset charge. Okay, can we end the poll?
Yes, sir.
So the correct answer is multi-period excess earning method, and the others are incorrect. And because in the multi-period excess earning method, you are trying to determine from the EBIT margin which is contributed by all the assets, you are trying to determine because it's an indirect method, as I had mentioned. Relief from royalty is a direct method. That what should be the royalty which you are going to save to earn this kind of revenue. So that rate adjustment, 1% or 5% or 10%, whatever we take, is already adjusted for the other intangible assets. Just move to the next question, Vijay.
Yes, sir.
So the question is, while using which approach ideally tax should be applied? And the options are three options only: market, cost, or income. Okay, we'll just wait for 10 more seconds and then we'll close the poll. Okay, Vijay, can we close the poll? So the correct answer is that it is applicable in case of an income approach. Somebody has still opted for a market approach. And I have explained that in market approach, it is not applicable because it is already implied in the multiple that we are trying to determine. Again, in the cost approach, think of it from that perspective, that if you are going to incur a cost of 10 rupees to build an asset, will you take a tax amortization benefit on that? The answer to that would be no. It would be illogical to take a tax benefit on that. Okay. Let's move to the next polling question, please.
Whether index exception is applicable.
So, well, whether Ind AS 103 is applicable in the following situation: merger, asset acquisition, business acquisition, or option A and C.
Business acquisition.
Okay, so the correct answer is option A and C. It is applicable in case of a merger as well as business acquisition, and not in case of an asset acquisition. Let's move to the last question of poll. Now, to measure the intangible assets, which of the following criteria is not applicable?
It is not applicable.
So, separability, contractual, transferability, capability. Just go through the question once. I'm just going through the question once again. Which of the following criteria is not applicable for measuring an intangible? Transfer. Can we end the poll?
Yes.
So the correct answer is capability, because all other three criteria, the contractual criterion, the separability criterion, and the transferability criterion has to be satisfied. Okay, so assuming more than 75% have responded on the correct answer, I take it that I have been able to do some justice and add some value add to the forum which is present over here. With this, we move to, and in due to paucity of time, maybe I will not be in a position to cover the full case study as I wanted to be, but I will just take you through the live example, though the numbers and all have been changed, but for the benefit of the members, I will just take you through as to how do we perform a PPA exercise in terms of how our model look like. I will not be in a position to share this Excel file with you guys, but I will be in a position to share the presentation which I had presented some while back. This is something which is proprietary to the firm, and I am just showing you as to how a PPA exercise has been. Usually we do it. I'm just presenting my screen again. If it is not visible, let me know. And we'll just take, is it okay if we exceed by 5-10 minutes?
No, no problem. No problem. Please take your
Okay.
time. We would like
Sure.
to understand the concept. Yeah.
Okay. So just going through the case study, and so the case study goes like this. Alpha has acquired a business of Beta for a consideration of 100 CR with a closing date of 9th of May. The closing date is important. The BTA signing date is not important. And I think that was the polling question where the result was less than 50% who got the correct answer. That was the only question where people got confused and got a answer which was not correct. And we did not fare in terms of the ICAI standards of having a 50% mark. So the tax rate which is applicable is 25%. The WACC and everything has been assumed over here. Again, the WACC has to be built up. How you build up the cost of debt and cost of equity? Cost of equity is around 15.7%. So I'll just take you through how our WACC table look like. So we take the risk-free rate, the risk premium. There is a beta based on the comparable analysis that we do. And there is a company-specific risk premium. Here I have assumed 0%. But let's say the projections are extremely aggressive based on the future growth potential or XYZ factors. You might apply a risk-free rate or a company-specific risk premium to it. I have seen varied practices that on WACC also people apply a risk premium. Usually we consider that it should be part of the equity. Cost of debt is assumed and effective cost of debt as 25% is considered. Debt equity ratio has been considered as 30:70 and you get a WACC of around 30%. So this is how the WACC.
So how do you consider debt equity ratio?
So ideally the preference is to determine based on the comparable comps. So whatever is the comparable comps debt equity ratio, that is something which we like to adopt. So even if the company does not have a debt, but technically if I'm saying like an IT industry, it will not have a debt, or it will have a debt of which is very less than 10% or so in the overall cap structure. Then even if my company does not have a debt, I will try and adopt based on the market point of view that 5 to 10% is the debt equity ratio which one we will consider. Okay, just so this is the PFI which is given. Not taking you through the numbers, but this is a PFI which is given, and there is a depreciation which is, so till EBITDA everything is okay. Now what happens is that when there is a slump sale which is happening, whatever is the fair value of the fixed assets, the tangible assets which we have determined, on that we will be able to claim a depreciation because there is a step up which is there in the fair value of the tangible assets also. So on that, whatever is the depreciation on the fair value of the fixed asset has been considered to determine the EBIT margins. Now, if you look at the EBIT margins also, it is coming in range. If it is not coming in range, maybe you can discuss internally with the acquirer, and if you have access to the seller, you can also discuss with the seller. the capex has been given just to determine the IRR. And one important thing over here which is given is the selling and the marketing expenses. Now here what is happening, that for the selling and the marketing expenses has to be for the acquisition of the new clients as well as retaining the existing clients. The ratio is defined for the purpose of simplicity, but in the real scenario, it is not like that, that many times you have to take a call based on the discussion that what should be the marketing expense required for acquiring the new customers, as we call it as a customer acquisition cost. Now the customer acquisition cost is something which you would not try to imbibe, and you will try to adjust the EBITDA margins on an upward front because you are just valuing whatever is there with you in terms of the customers and all, and not the future customers. So that is something which is a pro forma adjustment that we do in terms of our model, that whatever is related to the new clients or the acquisition cost for new clients is not inbuilt in the valuation or for the PPE exercise. So I'm valuing the brand using a RFR method. Now this is the revenue which is there from the operations. So if you see, the first year is basically a stub period of 10 months and 10.7 months or so, and then going forward it is, so I have considered, or for the sake of simplicity, I have assumed the life to be 5 years basically. So whatever is the revenue is getting linked from here for 10 months, and then I have assumed that the revenue attributable to the brand will be 100%, and then it will be going down to 10% or so. It is not that the brand is going to stop or they are going to discontinue with this brand, but technically the dependency on this brand is going to come down, and hence there is an attrition which is assumed. In scenarios, in real life scenarios, I have seen like this. My preference is not to take 100% retention rate, but take a staggering rate when we go down or towards the end of the life of the brand or the intangibles. I've also seen cases where it is all considered at 100% also. But what happens is then the chart is only moving up and up in terms of the pie chart. When I have to plot these numbers, it is only moving up and up, and which is not a correct scenario because the dependency on the brand will wither away. Otherwise, the life of 5 years is not being justified. I've considered royalty rate of 1.5%, assuming it's a B2B brand. If it's a B2C brand, the royalty rate will be much higher. And one thing which has to be considered is the brand maintenance cost. If there is a brand maintenance cost which has to be incurred by you, then technically this has to be reduced, a brand maintenance cost. And on a net of tax basis, you determine what is the cash flows available after tax. And you discount it to the present value, and you add the tab benefit to determine the fair value of the. Any questions in RFR? Otherwise, we move to the next method. And I have 7-8 minutes now to cover everything.
No, is Mr. Shah, you said like you will also do a benchmarking here. Okay, then if you do a benchmarking for the royalty rates, would you again align your rates? Like you have assumed, say 1.5% here. So like if you do a benchmarking and if the industry average is say 1.3, would you reduce it?
Sir, if it is industry average is 1.3, 1.5, I am considering 1.5, that is okay. If the industry average is 5 and I am using 1.5, then this will not be correct.
Okay.
But plus minus 5, 10, 15% is a tolerable range, which you have to live with it.
Okay, thank you.
So my question is more from the practical side. Who provides this royalty rate? Is it like provided by the company, or
No.
valuer has to do his own research?
Valuer has to do his own research. There are certain paid databases which are there, like Markables and Royalty Source, Royalty Stats, which give you those kind of research. Most caution has to be used what royalty rate you are determining. So that one more thing which we do basically is there is a rule of thumb which is there. So let's say just coming to this. my EBIT margin is around 6.6% or 7%. The rule of thumb says that I'm anybody, so 2/3 of or 33% or 25% is the royalty which one can consider. So technically 2% or something which is equivalent to 33% is something which acquirer will not mind paying. If the margins that they are going to get is around 7%, then 25% to 33% of that can be used as a rule of thumb while determining the RFR. So when we do the benchmarking, like sir was mentioning, that if the benchmarking rate comes to 5%, then we also try and see that my EBIT margin is 6.6, whether that 5% can be justified or not. So hypothetically, in a business scenario, if my margins are 6.6 and if I have to pay 5% as a royalty, I'm just left with 1.6% based on the tangible assets in terms of the funding of the working capital and the fixed asset. It does not make sense, basically. Are you with me?
Yes, sir. Okay.
Okay. Coming to relationship, and relationship I have valued using a multi-period excess earning method. Now, I have considered that the life is around till 2030 or so. So technically the life is around 8 years or so. I have considered whatever is the revenue which is given as per part of the projections and assumed an attrition rate. So this is usually that in the first year, my attrition rate will be around, sorry, what is the attrition rate which is assumed? It is around 15% is the attrition rate that has been considered. And I've seen both the practices. Somebody can use an average retention factor, which is an average of the previous year and current year. And so technically that 86 and 73 will become 80%. So the revenue attributable to the existing customer is this much, which is 93% of 1250. And it is going down because the dependency on these customers is going to reduce as we gradually move. And the new or the incoming new customers are going to contribute more to the future revenues. So the EBITDA margin has been retained at whatever is the EBITDA margin which has been assumed in the PFI, reduced by the depreciation. Here again, as I was mentioning, that since we are valuing only the existing customers, there has been an adjustment or a top-up which is made to the extent of 0.75% of the revenues. Now this top-up is required because you are not incurring these expenses for acquiring the existing or retaining the existing customers. So your margins, the EBIT margins will be higher to that extent. On a net of tax basis, your free cash flows will be determined. You apply a contributory asset charge to the fixed assets, working capital, assembled workforce. And since we are here valuing brand and non-compete also, I have applied a contributory tax charge to these two also. You determine the free cash flows and you discount it at a appropriate discount rate, add the tab, and you arrive at the fair value of the relationship. Coming to the last part, basically, this is extremely simple. Basically, let's say if you are valuing a non-compete over here, like, so this is based on the IRR that we determine that what is the free cash flow. You determine that because there is a competition which is in place, then what should be the loss in the revenue? The loss in the revenue has to be considered, and the EBITDA margins adjusted for the incremental cost. So what will happen when there is a non-compete agreement which is not in place? I will have to incur an additional marketing efforts to make sure that I don't lose much of the revenue to the competition which is there from the existing seller. So my EBITDA margins I have adjusted to the extent of 0.5%. Now this is very subjective. Ideally, you can look at the historical marketing cost and apply that average percentage to determine that this is the marketing spend which will be required. to whatever is the differential cash flows that is brought to present value terms. You add the tab benefit and you determine the fair value of the non-compete agreement. Now, how do I stack up in terms of the IRR?
Just one quick question, Mr. Bhavik, on the slide relating to contributory asset charge. How did you calculate contributory asset charge? What principles are applied?
Okay, so I'll take a simple example due to paucity of time. So these are the revenues. So here we are calculating the contributory asset charge for the fixed assets. These are the revenues which are given by the client. Now this is the fair value of the assets, which is around 12 crores. Whatever is the addition as per the model has been considered. Whatever is the depreciation as per the model has been considered. Whatever is the average between the opening and the closing, on that, what is the return expectation? And this is the return on the asset. So my CAC charge is basically in the first year is 1.05% of the revenue, going down to 0.93. And it is, if you look, since we take a long-term life for 25 years or 30 years, because that is how it will in a way average out. And if we look at this, the present value will come to around 0.63%. So it is not that we apply for the first year 1.05, then 0.93, 0.846. We apply an average rate of 0.63%. Is this clear?
Yeah, okay, thanks.
Okay. So this is how the exhibit or the summary will look like. My purchase consideration is 100 crores. My tangible asset value is, carrying value was 7. The fair value is 12. Other net asset, which is working capital, is considered at book value only. So which is 30 crores. This is attributable to the intangibles that has been identified and valued. And 12 crores is the balancing figure. There are certain pass-through items also, which is there basically, and which is around 25 crores. Now, if we look at the VARA, so first is the IRR. My IRR is coming to around 13.7% based on the projections that which was there in the assumption sheet. And I have matched that projections basically to the tune of 1,000 million. So if you look at this, my enterprise value is 750. Just consider 25 as a cash balance which is being transferred instead of a pass-through. The effect is the same. So my equity value is 100 crores and the implied IRR is 30.7%. Now, if I come to VARA, now what is happening in VARA? For fixed asset, my fair value is 12 crores of 750. Now, why am I considering based on 750 only? Because my business enterprise value is 75 crores and not 100 crores. So ideally, it should be pegged to 75 and not to 100 because this is something which is cash, which is there in the books. So this is technically 16% of my purchase consideration. Other assets are 30%. And overall, including goodwill, 44% is towards the intangibles. I have the fair values are listed over here. The rate of return. Now, this is something which I would like to spend some 2 minutes over here. Now, what is the rate of return? The rate of return is something which is like a specified fixed asset. What is the proportion of the debt and equity that you will consider? This is overall for a WACC analysis, I have considered 30 to 70, 30 debt, 70 equity. For fixed asset, I'm considering 40 to 60 ratio. And for working capital, ideally a debt will be on a higher side. So I have considered 50 to 50. I can also consider 60 to 40. That is not a problem. Even you can consider 75, 25, basically. This is basically your reverse calculation to try and determine what is the range in the WACC, VARA and IRR analysis. For intangibles, I am saying that there is no debt funding which will be available. So whatever is the cost of equity, on that I've added a 0.5% as the premium or the riskiness of the intangibles. And I have determined cost as 15.8% or so. For goodwill being a much riskier asset as compared to the intangibles or identified intangibles, I have considered 1% additional premium over and above to the intangible assets premium. So over there, my cost of equity will come to 17.3%, or the rate return expectation will come to 17.3%. Now, when I do the weighted average return on asset, it will tantamount to 13.9%. So when you look over here, my VARA is 13.9, my WACC, which we had built up, was 13, and this is 13.7. Ideally, a range of or a difference of 0.5 to 0.75 is a tolerable range. In terms of percentage, if I have to talk about 5 to 7% is a tolerable and an acceptable range. But then it depends upon your convincing power and your negotiation skills with the auditors, and how do you justify if there is a gap of more than 1-2% or so. So I think with this, I'm happy to take any further questions that you have, but thanks for your time. And it has been a superb experience sharing something, and I hope I have been able to do justice to the topic.
So quickly, tab, can you show one just a second, sir? How did you arrive?
So basically, a tab is something that, so it's a hypothetical factor, as I said, and how in the tax the working will flow, that if it's a 100 rupee asset and 25% is the depreciation rate, then what will be the closing WDV, what will be the return expectation, and what will be the present value benefit of it.
Right.
So if you take till 25 years, 30 years, then whatever will be the present value of the amortization benefit is something which is the tab that we are arriving at. Okay.
Bhavik, I have a question.
Yes.
So related to the earnout, for example, there is a contingent consideration, and we discussed that we need to apply the weighted average probability method to arrive at the to consider that in a purchase consideration. So that also we need to consider while allocating purchase price allocation.
Yes, sir. So let's say in the purchase price with the PC of 100 crores, there is also an earnout which is there of 50 crores depending on achieving of the EBITDA or something.
Yes.
Then 100 plus the probability factor of achieve or paying that 50 crores will become your purchase consideration. So 100 plus something.
Okay, so even though we have not paid that right now, it is contingent. We need to allocate the purchase price allocation for that amount as well.
Yes, because you have to do the business combination on the date of acquiring the control. So technically on day 1 or day 0, basically when you are preparing the books, at that date only you have to determine what should be the PC and you have to do the purchase price allocation. Basis that, let's say you have taken a probability of 50% being achieving or paying that 50 crores. So you have just taken a PC of 25 crores, that additional 25 crores also will have to be accounted as and when time comes.
Okay, and if, for example, that this 25 also we are not going to pay in future because the milestone has not received, then do we have to do some adjustment at that point of time?
No, there is no adjustment which you can do in a purchase price allocation. It's an accounting entry that one has to pass them.
Okay, okay.
When the expenses were increased for future customers, were the revenues also adjusted?
Not clear with the question, Vandana.
Yeah. No, for future customers, the marketing costs that were increased. Similarly, were the revenues also adjusted for future customers, in the sense were the revenues reduced?
The revenue was reducing. No, there was an attrition which we had assumed in that example.
Is that
So-
relating to new customers?
No, it is not. So the new customers, definitely you cannot account. It is only the existing customers that you are accounting today.
Okay.
Now, existing customers, there will be an attrition. There will also be a growth on account of existing customers.
Yeah.
So
Okay.
let's say, so that has been factored in the model.
Understood. Thank you.
So Bhavik, in your brand example, you have considered that the percentage, the total brand percentage to the total revenue is declining. So basically you are projecting that your revenue would be less allocated to the brand over the period of time.
Right.
But we are in that case, we are assuming that we are getting this brand on a royalty basis from third party, right? In royalty free method. Then if we are getting the royalty agreement with the third party, then irrespective whether the sale is happening with the brand or without the brand, we need to pay the royalty. Then why we are using the decreasing proportionate method?
So, sir, the logic goes like this, that the dependency on the brand will wither out. Otherwise, what is happening? Let's say you are taking a life of the brand as 5 years, and for the time being, we are assuming 5 years is the correct number that we are attributing the life of the brand.
Okay.
Then are we trying to say that in the 5th year, my brand sales will be 1,000 rupees, today it is 100, then that 1,000 rupees I should retire the brand at? Technically, the curve has to be like this, right? In terms of the normal distribution.
Right.
And to correct that, I am taking a attrition in terms of the revenue or dependency on the brand revenue.
Okay.
So as Sagar, you mentioned that I have seen cases when you take 100% also and you retire the brand at the high, but I don't personally agree with that kind of a logic.
Okay.
It looks very superficial to me.
Okay.
So what normally is the number of years you take for projecting brand revenue in the this brand that you mentioned?
It depends on many qualitative factors, basically, but anything beyond 7 years looks 7 or 10 years looks doubtful unless it's a very well-established brand like a Coca-Cola or a Thumbs Up, where I'm okay with taking till perpetuity also.
So you're okay with perpetuity also, right? It won't make it won't be wrong if you take a longer period. Let's say for IT brands like Paytm or something else, you obviously.
Paytm, I don't think I will agree with perpetuity.
Yeah, no, not perpetuity, but then everything is all about the brand in most of these IT companies. So taking only a short period of 5 years, let's say, may not be able to do justice to the brand or capture the entire value that somebody is thinking, is putting on the brand. In that case, can we take a higher number?
As far as you can justify the logic to it, you can take whatever number you like.
Okay.
But see, you have to also, you have to look at the, sorry, just to answer your question, sorry, who was it? I don't know. But basically, when you are saying that one is on the dependency also, you cannot assume that Paytm is not going to have any competitive forces coming into play. So that will also take a course that what should be the economic life that you should consider for a brand. Like there is PhonePe which has come up for Paytm, or other UPI apps which has come up. So we are just discussing Paytm as part of the example, not to be quoted anywhere. But so over there, a higher life of maybe a perpetual life looks doubtful to me, because it does not have a brand presence like a Thumbs Up or a Coca-Cola. Now, Coca-Cola has been in market for 25-30 years.
Understood.
Mr. Bhavik, this is Chandrasekhar. Organizers, she has to rush due to some urgent other meeting. So I would like to convey both of thanks. If there are any questions from members, we can take for 1 or 2 questions, or else we'll go ahead with this concluding session. Any questions from participants?
I just So one question, Chandrasekhar sir. So in case of a technology company and assuming that there is a slump sale arrangement, usually technology company, the biggest asset apart from the computers and software licenses are the human resources. So in such cases, I just wanted to ask the speaker whether human resource valuation is being done on a regular basis in his experience.
No, you don't. You are not allowed to do it. Assembled workforce is something which you cannot recognize separately. It forms part of the group.
It is not even provided in India's.
It is very categorically mentioned in the index that AWF is not part of. You cannot recognize separately as an intangible asset.
Sure, sir. Thank you so much.
Yeah. Participants, any other questions?
Mr. Bhavik, I have a question. So, with regard to tab, you should consider the geography of operation because a lot of merges are there. Like if you are merging with a subsidiary which is in, like, say, Europe or something, so you consider the tax rate, European tax rate, and then arrive at the tab, or you take an average rate.
It depends on where the acquirer is, no, Senthil.
Okay.
So if the acquirer is in Europe, then yes, obviously Europe tax rate will be applicable. The tax step up which is available in which geography is going to be of prime importance to determine the tab rate.
Okay. Thank you.
So participant, I think if there are no questions, I will take this opportunity to thank Mr. Bhavik Shah. He has taken a lot of interest and also the session now for last almost 2.5 hours, continuously starting from explaining PPA requirement 103 AS, accommodation 14, tab with the illustrations. I think Mr. Bhavik, your sessions are excellent. With the live examples also, you given some of the case studies. I hope this is useful for all the participants. I, on behalf of BVA, thank speaker for his time and also this enriching knowledge, transfer of knowledge to all the members. Thank you, Mr. Bhavik Shah.
Thank you. Thank you. Thank you so much.
Vijaya?
Yes, sir.
Can you show display this memento?
Yes, sir. Sure. Sir, is it visible, sir?
Okay.
Okay.
Mr. Bhavik Shah, this is our token of our appreciation from our BVA. This memento will be, how are we going sending Vijaya? Are we sending it by courier?
Yes, sir. We'll send them for you, sir.
I think this will be couriered to you, and thanks all participants.
Thank you. Thank you so much. Bye.
Participants, I think she has sent the feedback form also. I think you can share the feedback form also. That may be useful for the organizers. And Mr. Bhavik Shah, we will look forward for future sessions as and as required. We require your continued support.
Definitely. Thank you. Thank you,
Bhavik,
Zulfi.
can you also share your number?
Hi, Zulfi. How are you? Sorry.
Somebody has got the number. I think is it possible to put it in the chart?
I will just put it on the chat.
Your number and email ID.
So ड्राइवर को ये भी भेजना ना सर, फोटो तभी अर्चित को छोड़ने आए थे ना, पर वहीं पर वही स्कूल कोलंबिया, तो फोटो तो मैंने खींच ली, लेकिन अर्चित को लेने जाना है वापस 1 बजे, तो उसको भेजना है मेरे घर पर, गाड़ी लेकर चलाएगा। तो कोलंबिया कन्वेंट देखा है, पुणे में जो है, वही अपने जो मनी से घर वहाँ कोलंबिया कन्वेंट, तो वहाँ उसका 1:15 बजे तक होता है, 1 बजे जाने का।
Thank you. I have just shared it on the chat, my email as well as my number.
Thank you, Mr. Bhavik Shah.
Will you have the presentations also sent to?
The presentation I will circulate.
नंबर दे रहा है, नंबर मेरे को करना है।
Sorry.
नंबर चला जाएगा तो वो ले लो, तुम लेक्चर सुन रहे हो नहीं?
Can somebody mute, please?
Bhavik, if you can have the email ID written in the end of the.
I've put it on the chat box actually. You can just take
Would
it.
it be possible for you to put it in the last slide of the PPT also? So that will help us in case we want to connect.
I will do that. I will do that. Thank you so much.
Thank you so much, Bhavik.
These
Bye.
details we will upload in our BBA group also.
Thank you. Bye.
Thank you. Thank you.
Thank you, sir.
Thank you.
Thanks. Nice session. Very good session. Thank you.
Thank you.
Chandrasekhar sir, can I end this session? Can I end this session?
1 minute, Vijay. Just take the details. I'll put it in our WhatsApp group. His contact
Okay.
details.
Okay, sir. Sure.
क्या
सब्जी मार्केट, फूड मार्केट,
अंदर
पुराने लोग रास्ते में खड़े होते हैं ना, सबको वहाँ देते हैं। उधर में जो मार्केट था ना,
तो उधर वाला मार्केट में तो चलते ही मार्केट अभी भी चलता है 8 साल
तो सब हटा दिया। वो एक तो सब्जी मार्केट लगता था ना,
Vijay, I think you can close now.
No.
Vijay?
Yes, sir. I'm ending this
Thank
session.
you. You can close.
Thank you so much, sir.